If you have been watching markets this year, it probably feels like everything is happening at once. Geopolitics, debt stress, liquidity injections, currencies moving, assets behaving strangely. And the natural instinct is to ask, what will break next? What will spike? What should I buy? But 2026 won't be about one asset exploding or collapsing. It will be about something far more subtle. Markets no longer react the way we expect. Let me show you what I mean. Let's start with oil. If you followed headlines in 2025, oil should have been strong. We had wars, sanctions, geopolitical tensions, supply narratives everywhere. Yet look at this chart. 2025 was one of the weakest years for oil in a long time. Instead of rising on fear, oil quietly drifted lower. That's the first signal. The old reflex, geopolitics equals higher oil prices, didn't work. Markets didn't panic. They didn't chase headlines. They simply didn't react the way they used to. Even major geopolitical events, including Venezuela, failed to move oil meaningfully. That tells us something has changed. So, if markets weren't panicking in prices, where did the stress go? It went here. This is SOFR, the overnight funding market. And in 2025, SOFR volumes climbed to record highs, and now over $3.5 trillion. That tells us something very important. When institutions are confident, they deploy capital. When they're nervous, they park cash. This isn't speculative behavior, this isn't risk-on behavior. This is defensive liquidity management. So stress didn't show up in oil, it didn't show up as market crashes, it showed up quietly in the plumbing of the system. Now look at this comparison. In 2025, oil fell more than 20%, gold rose nearly 70%. That combination is extremely rare. For decades, the thinking was simple. When oil goes up, inflation follows and gold rises with it. But this time, oil fell and gold surged anyway. That tells us gold wasn't reacting to inflation. It was reacting to trust. Trust in balance sheets, trust in currencies, trust in the system's ability to absorb debt. Gold didn't spike in panic. It moved steadily and almost calmly. That's not fear, it's reallocation. And the shift isn't limited to gold alone. What's interesting is that industrial metals have been rising alongside precious metals, and that's unusual. Normally, industrial metals rise with strong growth, while gold rises with fear. Seeing both move together tells us something different is happening. It suggests capital isn't just hedging inflation or recession. It's moving toward real physical assets, not because demand is booming, but because supply is constrained and trust in financial promises is changing. This isn't a growth trade, it's a real asset repricing. Now let's look at Bitcoin versus the dollar. The dollar weakened through 2025. If this were a traditional cycle, Bitcoin should have exploded upward. But it didn't. Bitcoin fell early, rallied mid-year, corrected again, and then stabilized. No mania, no collapse, no mechanical dollar down, Bitcoin up trade. This chart matters because Bitcoin didn't react automatically. That's the theme of this entire video. Capital is no longer obeying simple rules. Instead of one safe haven, we now have multiple options, each behaving differently. Now let's connect the dots. Oil didn't spike on geopolitics. Stress moved into funding markets, not prices. Gold rose without inflation. Bitcoin didn't act as a reflex trade. This tells us something critical. 2026 won't be about one big reaction. It will be about fragmentation, different assets responding to different risks, different investors choosing different protections, different outcomes at the same time. That's why the old playbook won't work. If you're waiting for one asset to save you, one headline to explain everything, or one trade that works everywhere, you're likely going to be disappointed. 2026 won't reward reaction, it will reward understanding. Understanding of where stress is showing up, why capital is cautious, how trust is being repriced. Markets are no longer shouting, they're whispering, and those whispers matter more than headlines. If you found this insight helpful, like, share, and subscribe to MarketVelugu, Light on Markets. I'll see you in another interesting episode. Happy New Year to all MarketVelugu supporters.